Thank you. KYC, Know Your Client, has turned out to be one of the more controversial and intrusive aspects of regulation post-financial crisis. Whether it's private banks or commercial banks, they are demanding a level of information, both personal, financial, and background information from both new and existing clients. And processes like onboarding, monitoring, and managing the expectations of both a compliance department and banks has produced a lot of stress on relationship managers. And even 6 years in, this process is still undergoing evolution. I'm happy to have with me three specialists in this area, which I will introduce, if I can find my guide. Yes, right there. First is Anand, General Manager and Practice Head for the Regulatory Center for Excellence. Next is Govind, Head of Global Risk and Banking for 3i Infotech. And Muzammil, Partner of Enterprise Risk Services for Deloitte Touche Tohmatsu. I guess the first issue I would like to ask with regards to India is, since the major changes in KYC, and also you can't leave anti-money laundering out of it because that's the whole purpose of KYC, what kind of changes have been brought into India, and what are the domestic reforms compared to the international ones?
Okay. See, as far as India is concerned, though the KYC started during 2002 after the Basel Committee on Banking Supervision, the more focus has been given only from 2008 or 9. So if you see today's newspaper on Business Standard, RBI clearly says that the zero tolerance policy on KYC, even if your banks complied 99% or non-complying to 1%, they will be severely penalized. And currently the RBI or a BR Act only allows to slap penalty for 5 lakhs per violation. That ceiling has been removed, and then they are going to increase the penalty. To start with, I want to share some of the international best practices for next 10-15 minutes. Is that fine after the introduction?
Sure. Maybe anybody, if any of the other panelists have anything to say about my question.
Sure. No, I think KYC AML has come a long way in India from 2002. There's still a long way to go. The focus has, over the past few years, been heavily on sort of the customer onboarding piece and sort of the intrusive part around identifying the customer. There is a lot to happen on the risk monitoring side or the continuous monitoring side. But I think one of the positives that has come through both in RBI and SEBI regulations recently is the sort of gradation of customers, realizing that different customers for different products come with different risk profiles. And in a sense, regulators are starting to understand that perhaps the cost of compliance around KYC could be going overboard and actually hurting the financial inclusion agenda. So I think one of the good pieces that has come through in sort of Indian regulation has a lot to do with the fact that the risk profile of customers and the sort of products that customers are dabbling in is being given a fair amount of focus in deciding what the depth of KYC should be around those customers.
Yeah. See, KYC is one aspect where if you ask any bank, yes, there can be a regulatory visit this year. So maybe this percentage can be around 75% or 90% of the bankers would say KYC is the one aspect in which I can be penalized by the regulator. Not only in India, the percentage would be the same across the globe. Okay. In the KYC, the trend what we see, it is getting integrated. It is no longer a frontman job, or it's no longer an RM job. It has to be a comprehensive, integrated exercise, starting from the client relationship to operations team, to the AML team, to the IT team. It has to be a completely an integrated exercise, so that the KYC job becomes complete. Yeah, I think we'll chat as we go along.
I think from the numerous people involved in KYC, all the way from compliance to technology people and firms, and especially to banks and the relationship managers, I tend to think that principles, using a principles base as opposed to rules base for KYC from the client point of view creates a lot of problems. It creates, and the main problem is never-ending due diligence, because there's no specific standard in place that says everything is clear. And the only thing that seems to keep clients in the process is that if they go to another bank, they're faced with the same requirements. Yeah. So I'd like to just hear what the panelists think of, and some of you are involved in the consulting aspect and the technology aspect of it. Will this just be a never-ending process for onboarding, for monitoring? How do you see your clients evolving to meet that?
Okay, shall I take some of the slides? I can show that.
Sure.
Yes. See, the timing of this summit is very significant when the Indian economy is poised for double-digit growth, and India could be the natural destination for investors globally. Though the foreign investment is important, it is equally imperative to know who the investors are, to know who is the customer is. Just, I will share some of the international best practices to answer your questions. See, this is just to show the lot of regulations which is currently impacting the banking. As you are aware that last 2 to 3 years, the CEOs and chairman of the banks spoke more about the regulation and compliance than about the revenues and business models. And moreover, the regulators' expectations are dynamic and unprecedented. Among these various regulations, the KYC and AML is currently focused because a lot of enforcement actions has been done. Almost 13 billion has been penalized in last 2 years in respect of only 3 banks. So this is just a AML framework. The top and bottom line shows the industry and regulatory expectations are all between the blue one or the bank specific ones. Think about that, such a complex process where the banks are facing now. Obviously, the technology and resources are the key one, which both my colleagues will touch upon that. See, this is 7 steps related to KYC. Most of the banks still feel that KYC is only identification and verification of documents. Especially in some of the local banks in India, they think that it is a paper gathering exercise and tick box, and their work stops once they collect the documents and verify the documents. It is not so. Globally, we need to go and meet the regulatory expectations. So there are other important steps, that is 6 important steps, that is unwrapping and capturing the board of directors, authorized signatories, and pledgers, investors, funds, and then screen them against the watch list to identify whether any predicate crime is there, or they are the blacklisted guys, or it is embargoes or against them, anything. And then each and every customer of the bank has to be risk rated as either high, medium, low. After that, the bank, based on the risk appetite, they can go and decide whether to onboard or reject the customer. Once that is being done, the due diligence starts. If it is a low risk customer, you can apply simple due diligence. If it is a medium risk, you can apply standard due diligence. If it is high risk, you have to apply a strict due diligence. So after that, there is a periodic screening has to be done across that. So why CDD is important? Basically to avoid undesirable customers. I don't know how many of you agree that this is high-risk process and complex process, because 3-4 years before, and when I spoke to one of the CEO of the country of international bank, he clearly mentioned that KYC is a no big deal. We have done a lot of activities like treasury, investment banking, so we can do this no big deal. After 6 months, I come to know same person told KYC is a monster. I lost 2 of my IIMs and IITs because when I told them to do the KYC, they told they cannot do that. So most of the banks accept KYC is a complex process when compared to last 4 years they are. So this is, as I mentioned, that RBI is so vigorous on slapping penalty on KYC. As Govind told, this is a one area where the RBI inspector can find lot of gaps in the banks. So that is very easy for them to find gaps. It's because the Indian banks have to improve drastically more vis-a-vis the international banks. Even the same for international banks, because most of the penalties in last 3-4 years is because of either the KYC or AML penalties. Just I want to touch upon one of the last point here. See, if there is a negative allegation against the customer, always the RM or the head of business says that, no, he try to downplay the negative allegations, saying that the customer is a very nice, trustworthy, respectable family, or he is in the Force 500 or Force 100 list. Please don't get carried away by that. Compliance cannot be compromised because of the revenue generations. See, some of the key themes in KYC is unwrapping, on politically exposed person, on risk assessment. See, I don't know how many of you can agree with me that each and every customer, or especially the legal entity, should be unwrapped till we identify the natural persons. Because what you see from the paper or what you see from the interaction is totally different. Legally, the person, the owner of the company is totally different. Especially in India, most of the corporate entities, the final unwrapping goes to trust or family business. We don't know who is the real owner of the company itself. So regarding screening, yes, I told the screening should not stop just screening the name of the entity or a customer. We have to capture all the intermediaries and board of directors, senior management, and pledgers, guarantor, everything. As far as foreign investment is concerned, the funds plays a major role. Basically, the SEBI or RBI says that funds falls under the category number 1, it is a low risk. But at the same time, I suggest that there should be caution on these funds, because I personally come across some of the sovereign funds which is linked to politically exposed person. That PEB is linked to corruptions and scandals. So that's the reason I put the PEB. In India, PEB is basically to identify the foreign PEB, but globally the domestic PEBs has to be covered. And one more thing is that PEBs, they never come directly and open the account with the banks. They always use either the close associates or the family members to open that. So we need to identify the PEB behind each and every account. So that is very important, because the PEB poses corruption and bribery risk. See, this is some of the politically exposed persons globally who are owners behind a lot of shell banks and shell funds, and we have to be very careful in dealing with them. This is a risk assessment. As I told you, each and every customer will be risked high, medium, low. These are some of the factors which decide the risk assessment, because as I mentioned earlier, the identification and documentation alone is not sufficient. This is the final one I want to say. Most of the times we come across the compliance says do not onboard the customer, whereas the senior management or CEO says no, we need to onboard because this gives a lot of revenues. Yes, definitely the particular year the client is very happy and the bank is also very happy because they earn a lot of profit. Always a penalty comes after 3 to 5 years. So now recently, apart from penalizing the banks, the international regulator, especially the US FinCEN, started penalizing the AML officers and chief compliance officers. In one instance, the person has left 5 years before the organization, he has been penalized, has to pay the X amount of money. So as I mentioned, you don't always get a second chance. KYC has to be done at the first. This is some of the international best practices I like to share. After my colleagues sharing their experience, we'll take up the questions.
Thank you. Do you guys have any additional thoughts to add to the presentation here?
Sure. No, I think you raised a very valid question about the sort of pain that KYC has become, and a sort of an iterative pain that it has become, with every bank people go to. I think we're sort of at a stage now where there needs to be a unified KYC, which is not just applicable to the banking industry, but it's applicable across industries. If today we're talking about differentiated banks, we're talking about financial inclusion, we're expecting a telco to have the same standard of KYC as a bank. Only then will that whole process work through. You're expecting various customer touch points. You're expecting customers to be reached through various channels. Will all those channels be in a position to undertake the same levels of diligence that a bank would do at its front end or at its branch? I think those are really the challenges that we're looking at today. So I think some of the things that Anandan mentioned were quite valid, and I think applying a lot of that in a unified manner, in a codified manner across industries will be extremely critical to make this whole KYC process seamless for the customer, and also ensure that the same level of quality is being maintained even outside the banking industries as customers get sourced more broadly and not just within the sort of traditional banking channels that we're operating with.
Taking a cue from what we have been spoken, recent trends include KYC repositories, which is like a common forum. Maybe the equivalent what we see is in CIBIL. CIBIL few years ago, we had nothing, but now without CIBIL, nothing happens. So on the similar lines, what we are seeing is KYC repositories coming. There may be challenges, there may be regulations in preventing data being shared, data confidentiality requirements. I think we should come beyond these things. This is happening globally. And in fact, many companies are based in India, serving for the global clients on these methods. So it is now in India. If we move forward, it is like a win-win situation for everybody. One side, we need not repeat what another bank has already done. And these KYC repositories come with efficient forums. So the entire process becomes efficient. It's a quick decision making can happen. So it's a win-win situation for all.
Do you think despite the massive number and amount of sophisticated systems being offered to manage KYC for both national, regional, even international banks, do you think it really making it work and taking the client through it, is it really mainly an RM issue? Because a lot of RMs tell me a lot of extra time, a lot of extra effort, multiple meetings have to be made with the client as accountant, directors to ensure that they're taken through the process, no matter how good the interface is with in the front end on the computer screen.
You want to take it up? Okay. See, as Govind said, it is not an RM job so far. RM is basically is a person to meet the client and get the documents as required by the policy procedure of the bank. At the same time, one of the important aspects it has to be followed is RMs has to be sensitized about the policy procedures of the bank and also the industry best practices. Practically, the RM face the biggest issue that they always say that they are not in a level playing field with the rest of the banks. For example, international banks, RM says, the local banks are not asking these questions, whereas you are asking. Customer is asking the RMs. So local banks are not asking these documents, whereas you are asking. So we cannot provide. This is some of the challenge RM faces. But yes, RM is a phase of the bank. At the same time, a lot of other units like operations, compliance are involved, even audit is involved in meeting the KYC compliant.
Well, I think it's kind of ends up always being the RM's problem. Whether a customer is onboarded in time or not. It doesn't matter whether the RM knows. It doesn't matter whether the RM can do anything about it. But the RM kind of becomes a bit of a shoot the messenger kind of situation from both sides with the RM situation. I think there are a couple of challenges here. I think you've got a scenario where RMs may or may not be adequately empowered and be educated on exactly what is required. The second challenge is the customers themselves may not be adequately educated on what is required. And part of this challenge is not because there is no operating procedure manual or there is no sort of checklist that people are operating with, but the pace at which the requirements are coming through on KYC. Every time a new sort of a variant is found, a new sort of a deviant is found, you will find a new requirement that gets tagged or attached to it. And the pace of this evolution is sometimes not, or the speed of dissemination of information around this pace of evolution is sometimes not finding its way onto the front lines with the RMs and with the customers. It creates a bit of a delayed process. It creates a bit of a painful process, and eventually the RM, kind of becomes the punching bag for the whole piece. I think it's important for banks to recognize that with every change that happens on the KYC AML front, there has to be a change management and communication process right down to the front lines. I think once that starts happening in a more structured manner, some of the challenges around KYC, well, at least the documentation challenges around KYC and the RM pressure around it will perhaps be alleviated a little bit.
Thanks. Do you guys think that ultimately too much KYC or an unmanageable amount of KYC threatens economic development, because there'll be quite a number of businesses, individuals who will not be able to access banking services that they used to be able to, and these are legitimate individuals too. Any thoughts on that?
Actually, what happens is there is no regulator who can come and tell you exactly you'll have to do 1, 2, 3, 4, 5, 6, 10 things. So at the end of the day, there will always be some judgment you will have to deploy. So as long as you are done your due diligence, you are in the position to prove to the regulator in future saying, these are the reasons, based on these reasons I have done this, these are the due diligence I have taken. So I think that should suffice. If there is never a question, there is never an answer what KYC is sufficient. It will always be a debate. But as long as you can document what is in your view the best, you have done the best due diligence, you should go forward.
See, to answer your questions, yes, in Reserve Bank of India clearly mentioned for no-frills accounts, basically to improve the financial inclusions, there is a very, very limited KYC is required, not to go for exhaustive ones. So that will facilitate more number of farmers or a population assess the financial institution, financial services.
I think the question on, is KYC too much? I don't think there will ever come a time where too much KYC is too much. There will always come need for additional information. There will always come additional needs for monitoring. There will come additional needs for intrusiveness. A lot of this or the whole experience is based on availability of data, whether that data is centrally available, whether that's available with a bank. But I think the answer to that is there will never be a point where KYC is too much. There will always be sort of additional needs around it. I think the important piece here is not just about how one creates needs and creates documentation. It's about how one is building their processes to interpret those documents, to take from it and actually make a lot of risk sense with it. Today, a lot of the KYC processes are run with the intention of collecting as much documents, because that will give a false sense of comfort that if I've got all the documents, it's perhaps all right. What one is taking from those documents, what one is databasing out of those documents, what sort of decision support one is building around those documents, I think that's really where one will be in a position to determine whether or not KYC is enough. Or you're just going on and on piling requirements onto it.
Sure. The reason I ask that is because from the KYC regimes I've seen building over the last 5 years, one group of proponents argue that it's more than just trying to determine whether your client or counterparty's an outright criminal, but the standards keep getting raised because now you're trying to determine if he's a terrorist, all sorts of various affiliations, and the need for a history of your counterparty as company going so far back that for a lot of family-owned companies, it's almost difficult to document. Do you find the documentation problem to be a major issue?
Yes, especially when it comes to the family-owned business, the documentation is a major issue, and then the data. Who is the ultimate owner? Who is the intermediaries of this company? Actually, the CEO or the board of director or a senior management of the particular corporate is also not aware of that. Especially for India, China, and some of the South American countries, the corporates finally goes down to a trust. So that is the end of it. So very difficult to identify who is the end owner of the company.
Mm.
Yeah, there is not much of information available publicly or even through externally subscribable formats.
Mm. Well, ultimately, the KYC process wants to know who is the ultimate beneficiary,
Yeah. Yes.
don't they?
Yes.
The person, not some,
Natural
not
person.
another company or an entity.
So we need to identify a natural persons. That is ultimate.
So that's a complex, manual, laborious job, but the regulator expectation is very clear. You should know the ultimate beneficiary, and there is I don't think there is any escape going forward.
Mm. 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 And how do you guys see the evolution of systems?
I think, KYC AML systems have come a long way. We're talking about 2002 to 2015, and I think serious development on technology started around 2005. So I think in 10 years, KYC AML systems have come a very long way. They have been able to build a level of process orientation. They have been able to build a level of sort of standardization across the enterprise. I think where you will see a lot of these systems now starting to evolve into is in the analytics space. You'd expect a lot more customer analytics starting to play its part. Of course, the regulator does not allow you to use KYC analytics to cross-sell, but the kind of information that is available at the point of sale is something that will start getting used a lot more the other way around onto the KYC analytics. So I think that's a space where you'll expect systems to evolve a lot more. You'd also expect technology to start becoming interoperable and harmonize information flow between enterprises, whether that's facilitated through sort of centralized repositories of KYC, or that's facilitated through other regulatory arrangements. But that's the other area you'd expect technology to evolve a lot more in terms of making that information more widely available.
Thank you.
I would add a few points to it. See, technology is here to stay. I don't think, given the volumes the banks are seeing, its technology is going to be staying here. Without technology, I don't think they will be able to make any decisions from the KYC compliance perspective. One more point is that now we are looking at doing a real-time KYC. It may be a real-time screening. We want to do before onboarding. At the point of time when the documents have come, the RM has brought a new customer, I want to onboard him now, immediately. I don't think without a solution we can move forward. So the real-time KYC is the one which is getting popular these days. I think it is one of the recent trends. Then screening. One side, the negative list, the external list keep increasing, gets updated very frequently. You'll have to be sure you're screening against the latest list, otherwise there is no escape in future. Then we know banks involved in multiple business processes. Then they use different systems for different, say, CASA accounts in a different system, credit card accounts in a different system, or your business banking in a different system. And your AML solution has to integrate, otherwise we will never see a comprehensive customer view, and we'll take the appropriate call. Without technology, you cannot take an appropriate call.
Thank you. I'd like to open this up to any questions from the audience. Go ahead. Gentleman in the front.
Well, Peter, I'd like to put a thought across to what you just said. If you look at the FPI process, the entire KYC policy, which has happened over the last 1.5 years, is following the global model, which is risk-based approach. And effectively, the KYC requirements for Category 1 and Category 2 has significantly come down, which has enabled actually investments to come into the country. This is one observation, and I thought I'll just share with you. And in a sense, if you look at some of the steps that the regulators have been taking in this country, they are just listening, and there's a synchronizing between the RBI and SEBI. Yeah. So this is something I thought I'd just share with you all.
Sure. Thank you. Over there in the back.
Hi. Most of the compliance related areas are typically focused on concentrated in mid-office of a treasury or risk-related departments. But if you see KYC and compliance in a bank or a financial institution, it needs to cover almost all the operational staff and the branch staff. What could be means of doing that, and what could be challenges in doing that?
Well, I think, well, you're right. KYC is a very pervasive process. It's not just pervasive from the point of collecting customer information, but it's pervasive from a point of view of ongoing monitoring as well. I think the challenge with KYC even today is that it is largely concentrated, or the delivery of that KYC service is largely concentrated in a KYC AML unit. It's sort of supplemented by compliance. It's supplemented by the financial crime management units. That's kind of how it is. It's operated on the ground in reality. The ability to make it pervasive or to make it part of the bloodstream of everybody across the enterprise will require a significant amount of training. It will require a significant amount of sensitization. It will require a significant amount of scenario building to explain to people of events, what have happened, how they have transpired, what has led to those issues, how regulators reacted to it, and to be in a position to do that differentially by product or by business unit within the organization. Today, most business units understand KYC as a document collection and parceling process. They understand it as a reactive process to compliance needs. But I think the ability to bring it as part of the bloodstream will be a lot more about proactive education, and be in a position to build scenarios and explain to people what it means for their business. I think that's the piece that's really not completely set in yet.
Okay, just to add to that, Muzammil's point, currently the KYC is concentrated. Once the RM collects the documents, it goes to the back office where the making and checking has been done. And once for low and medium risk, that is being taken care by the business themselves. Only for high risk, the approvals comes to the compliance. The basic purpose is that the business has to own the KYC function. The compliance comes only whenever there is a high risk, and there is a defensive mechanism for that. That is how it is operated internationally. Regarding the training part, there are separate, apart from the mandatory e-learnings or refresher training for the entire staff of the bank, RMs are, now the separate training module has been developed in some of the international banks exclusively for RMs, how to talk to the client to get the KYC information.
Thank you. And our last question?
So there's a lot of discussion about what is too much KYC or too little, and how much of a burden it actually puts on the banks, etc. I think, Mr. Patel, you were getting to this. What about actually testing how effective it's been post facto? Like, how effective has it been in identifying the money launderers or the criminals, or even more importantly, in terms of identifying the expected loss or unexpected loss in your portfolios as a result of the KYC procedures, and then deciding how much KYC is enough?
Sure. See, I think the problem with KYC issues is you need one instance, just one instance to nullify the work done on a million other instances, right? You could very well be in a position where you've processed 1 million transactions, you've onboarded 100,000 customers, and you got one bad apple, or you got one bad transaction, right? And that's really when that one transaction happens. Too much is not too much then, right? There are mechanisms in place even today to measure the effectiveness of some of the KYC processes. For example, banks in India go through a significant concurrent audit process where every transaction is checked 100% on the KYC front. On the FBI side as well, there is a mandatory requirement to be subject to internal audit, where again, it tends to be a nearly 100% sort of a check on every customer onboarding. So I think there is enough sort of backup mechanism in place to check whether the KYC pieces are working to regulation and working to policy. You make a very valid point to say how many have they been actually able to identify. How many times have they actually been able to pick up something because the process was good? Yes, that data is there, it's available, but whether one can actually use that data to make judgment on relaxing some of these pieces will always become a challenge when that one instance gets found out. Right? So you may do it all right, and then that one instance comes by and it spoils everything in that whole process. And that's not about to change. It's unlikely to change because the sort of regulatory pressure on it across the world, whether it's the OCC in US, whether the successors of the FSA in UK, RBI, SEBI, everyone's been focusing on those one instance. They're not looking at the other 9,999 which you did right. So it is what it is today.
Okay, well, thank you very much to the panelists for their contribution and ideas. And I would like to invite you for our a lunch next door, and we will return in an hour. Thank you.
Thank you.
Thank you.